Now we're going to look at treatment of specific partnership items. Specific partnership items that are relevant for determining the partnership profit, allocation of partners' share, and tax liability of each partner are interest on capital, drawings, and what? Salary. First, look at interest on capital now. And please take notes. Make note in your mind if you can. Write it down, please. Alright. Partners usually receive by agreement interest on the capital they have contributed to the firm. Giving each partner interest on the capital contributed is giving each partner interest on the capital contributed is similar to a company paying a dividend to its shareholders. It is an appropriation of profits earned from the use of the capital employed. If the interest has been charged to the profit and loss account in the final accounts, then this must be added back. And go again. If the interest has been charged to the profit and loss account in the final accounts, meaning the interest and capital, right? Then this must be added back to the profit adjusting statement of the partnership. Alright? If the interest has been dealt with in the profit appropriation statement, then it is not reflected on the profit and loss account, and there is no need to add it back in the adjusted profit statement of tax purposes. Let me go again. If the interest on capital has been charged to the profit and loss account, and folks, watch the video, focus, alright? If the interest has been charged to the meaning it is used in the calculation of profit and loss, alright? So if the interest on capital has been charged to the profit and loss account in the final accounts, meaning in the income statement, then this must be added back in the profit adjusting statement of the partnership. Right? If the interest has been dealt with in the profit appropriation statement, then it is not reflected in the profit and loss account, and there is no need to add it back in the adjusted profit statement for tax purposes. Alright? Let's look at an example now. In the partnership accounts of Earl and Sharon, who are in partnership, sharing profits equally, the earned accounts declare a profit of 44 million after charging interest and capital 20,000 each. That means it was deducted from the profit to arrive at what? 4 million. So it was deducted from something to arrive at what? 4 million, right? The profit must be adjusted by 40,000 because it's 20,000 each, right? To 4,040,000, as the interest is a payment to them for the use of their capital, right? Assuming there are no other payment adjustments, the partnership profits of each will be 2,020,000. Alright? Hope you understand a little better what I said a while ago. Let me go again. In the partnership accounts of Errol and Sharon, who are in partnership sharing profits equally, right? The year ended accounts disclose a profit of, that means the end of year disclose a profit. When they do the calculation of profit, they got $4 million, right? After they'd have charged interest and capital, meaning they'd have interest and capital is normally charged as an expense, right? So they'd have subtracted that now from something to get to what? 4 million. Now it is said that if that is done, it must be added back to the what? Profit for taxation purposes. Good? So therefore, the profit must be adjusted by what? 40,000 to 4,040,000. As the interest is, and why 40,000? Because it's 20,000 each, right? As the interest is a payment to them for the use of their capital. Assuming there are no other adjustments, the partnership profits of each will be what? 2,020,000. Alright? That's that for that. Look at now drawings and salary. In a partnership, there may be a salaried partner who is an employee, a partner who receives a salary allowance, and and participates in profits. A partner who receives sums as drawings throughout the year. A salary partner who does not participate in profits is an employee of the business, and his salary is an expense to the business and will be subject to the usual statutory deductions, including what? PAYE. Go again. A salary partner is who does not participate in the profits is an employee of the business, right? And his salary is an what? An expense to the business and will be subject to the usual statutory deductions, including PAYE. A salary partner who by agreement receives a monthly salary, sometimes referred to as a salary allowance, and participates in profits is receiving an appropriation of profits, albeit as regular monthly payments. This is usually done so that a partner who is doing the work on a daily basis is remunerated for the work, and this is usually treated as a first charge on the partnership profits. For income tax purposes, the annual amount paid to a salary partner is an appropriation of profits, and if his salary had been debited to the profit and loss account in the accounts by being included along with other payroll amounts, then the gross salary of the salaried partner has to be added back to the what? Accounting profit. Once it was in the calculations of what? The profit and loss for the business, right? It will then be reflected in the allocation of the adjusted accounting profit. A salaried partner will bring his personal annual returns of income, the total amount of his share of profits, salary, interest, and profit share, and to this he will add income from any other source such as dividends. If he has paid tax by PAY deduction, this amount will be credited against his tax liability for the year. Alright. Where a partner receives amounts as drawings throughout the year, these sums are appropriations of profits, and accounting entries debit partner's current account, credit what? Bank. The drawings are not usually passed through the profit and loss account. Therefore, there is no need to add them back in the computing the adjusted profit statement, unless the amounts have in error been treated in the account as salaries, right? Partners in this category should pay quarterly estimated tax throughout the year in the same way as sole proprietors. At the year end, each partner's computation will be his total share of partnership profit, drawings, interest, and profit share, and to this he will add any other sources of income in completing his annual return of income. Alright. Let's look at an example now of to further explain these information in detail. Peter Associates is a practice of three dental partners, Andrew, Beth, Karen, who each receive a salary of $1 million, on which PAYE was paid monthly. For year assessment 2014, Peter Associates' gross income was 14 million. Notice, there is a salary of 1 million, right? Each. Of which profit of 8 million was arrived at after debiting all salaries to the profit and loss account. So all salaries, the 1 million each, or 3 million, was placed, was used in the calculation of the profit for 8 million. What does that mean? Let's go. Andrew and Beth are full partners sharing the profits equally. Corin is a salaried partner and does not participate in profits. What does happen here? Let's go up at top. Let me back to something here. A salaried partner who does not participate in profits is an employee of the business, and the salary is what? An expense of the business, and will what? Be subject to the usual statutory deductions, including PAYE. A salaried partner who by agreement receives a monthly salary, sometimes referred to as a salary allowance and participation in the profits is receiving a what? An appropriation of profits, albeit as a regular what? Monthly installment. So these, so both the other two persons, both Andrew and what them? Andrew and Beth are salaried partners who receive a salary allowance, right? Because they participate in what? Profits. Good. So for income tax purposes now, the annual amount paid to a salary partner is an appropriation of profits, and if the salary has been debited to the profit and loss account in the accounts by being included along with other payroll amounts, then the gross salary of the salaried partner has to be what? Added back to the accounting profit. Alright? Um Now again. As it relates to Andrew and Beth, theirs is usually treated done so that theirs is usually treated as a first charge on the what? Partnership profits. Alright? So let's pay attention to what does that mean here now. Now, so Corinne is a salaried partner, right? Now in the profit tax adjusting statement of a partnership, the salaries of Andrew and Beth will be added back, increasing the profit to what? 10 million. In the annual returns of Andrew and Beth, they will each bring in 5 million share of the partnership profits, assuming there are no more adjustments in the partnership accounts. And the PAYE paid will be a prepayment of their total tax liability. Now, if Corinne has no other income, her tax liability for the year is discharged by her PAYE deductions. Right? So Andrew, so both Andrew and Beth are liable to pay minimum business tax as the threshold of 3 million is exceeded when the gross income is divided by the profit ratios. Hope you know what that hope you can understand what's really happening here, right? Now go again. Now let's go back up top a little bit. Hope you're okay with that, right? Now, a salaried partner who doesn't participate in profits is an employee of the business, right? And his salary is, is an expense of the business and will be subject to the usual statutory deductions, including what? PAYE. A salaried partner who by agreement receives a monthly salary, sometimes referred to as a salary allowance, and participates in profits, is receiving an what? An appropriation of profits, albeit as a regular monthly installments. This is usually done so that a partner who is doing the work on a daily basis is remunerated for the work, and this usually treated as a first shot on the partnership profits. Alright? So for income tax purposes, the annual payment amount paid to a salaried partner is an appropriation of profits. And if this salary had been debited to the profit and loss in the accounts being included along with other payroll amounts, that then the gross salary of the salaried partner has to be added back to the what? Accounting profit. Alright, now Corinne is an employee of a business. But for Andrew and Beth, they fall under the situation where they are being paid a monthly salary and they are participating profits. So in that case, their salaries should be what? Added back to the adjust the accounting profit. Alright? Good? Alright. So that's why I have it back up to 10 million. And then 5 million each for them both. And then for Corinne now, if Corinne has no other income, her tax liability for the year is discharged by her PAY deductions. Alright. Let's go to the example on Janice and Jonathan. They operate a self-service car wash facility in partnership, sharing profits equally. In the year of assessment 2014, the profits of the car wash were 4.4 million after charging depreciation of 250,000, partners joins of 1 million, GCT interest penalty of 50,000, interest capital Johnny is 200,000, Jonathan 350,000. Capital allowances have been computed at 580,000. Jonathan is 65 and receive pension income of $72,000. Janice receive professional fees for a consultancy gross of $250,000. In during 2014, Jensen and Jonathan paid estimated tax of 130,000 and 90,000 respectively. The partnership adjusted profit statement and the partners' annual returns are as follows. Now, I'm going to ask you to pause the video and write this information down, please. And if you can write them in list form, it will be better for you to understand. Alright? So let's go through this example now. You can know what is happening. Alright? Let's go. First thing you do is, so what you're asked to do is you're asked to do about partnership profit. You're going to do a partnership adjusted profit statement now. Alright? That's what we're going to do now. Good. So James and Jonathan in partnership accounts, New Year Assessment 2014 now. You're going to start with profit per account, which is 4.4 million after. Alright, good. They're going to add it back depreciation, as was mentioned when we were doing the part regarding sole trader, which is 250,000. You're going to also add back partners' drawings, right? Why? And this is 1 million. Why? Let's go back up top to remind ourselves, right? So where partner receives amounts as drawings throughout the year, these sums are appropriations of profits and accounting entries debit partners current account and what? Credit bank. The drawings are not usually passed through the profit and loss account. Therefore, there is no need to add them back in computing the adjusted profit statement unless the amounts having error been treated in the account as what? Salaries. Good? Now in this case, the reason why we're adding back the partners' drawings is because they have been treated as what? Salaries. Why? Because the question said that in the year of assessment 2014, the depreciation of car wash formula after the profit after car wash was 4.4 million after charging the depreciation and what? Partners' drawings. So drawings is seen as salary here. You say what it says after, right? So therefore that's the reason why I add back the partners drawings. If it did not say after charging this, we would not put drawings here. Alright? Good. So we would not put drawings right here. If that wasn't the case. That's the reason why we add back drawings here. No? Then now we'll look at interest on capital. Now interest on capital now, Johnny is 200,000 and 350,000, right? So we're going to add in those now. And we're also adding the GCT penalty. Tax matter not allowable. Alright. I add up everything now. You get 1.8. Why would you add back interest on capital? Let's check back again. Alright, sorry. Now, what does it say? Parents usually receive by agreement. So it says if the interest has been if the interest has been charged to the profit and loss accounts in the final accounts, then this must be what? Added back in the profit adjusting statement. That's the reason why I added, because it was what? It said, the question said what? Example said what? After charging what? Interest on capital. That's the reason why we did it. So you're adding back the things that are what? Not allowable. That they are not allowable deductions to come up with profit. So, the essence of it, then, folks, is that you are trying to bring back into profit calculation what was taken out of it. Then, meaning, say you would have say for example, depreciation would have been taken out to get reach a profit. The rule is that depreciation doesn't affect profit. It's not a, it's not something that will so all these things basically what they are really trying to do is to come up with the appropriate profit that should be based on the rules of taxation. Alright? Now we add up all these things, add it back, you get 6,250,000. Alright? That's that for that. Then now you're gonna want less capital allowances. And so that so the capital allowances have been what? Computed at what? 580,000. Alright? Now that is so there's a capital allowances and that will give you, so the partnership profit now would be what? 5,670,000. And that would be a partnership profit, right? Then you're gonna share this now, meaning you divide it by two because the question said that Janice and share profits what? Equally. So this now would be the amount of profits. As just the profit that would be shared equally. And then that is you share them, add them back together, and then balance off, and that's it. Alright. This that was the part where you do the what? Partnership accounts. Alright. Now we're gonna look at the Janice and Jonathan as it relates to how to as well as income tax computation, right? This is just a rule or routine we call it now. Alright. Now so you draw this up now, you have Janice and Jonathan columns. You put in the what? Share of profits. Good. Then you put in what? Interest and capital. Um then now so these are all your we call now all your would have been income. Alright. Now you put in the additional income of consultancy fees, and then you have pension income of 72,000. Why? Let's look at Jonathan now. Jonathan, um, Jonathan is 65, right? And receive pension income of 72,000. That's the reason for that. Alright, good. Jonathan receive professional fees for consultancy gross of 250,000. That is all by herself. For Jonathan paid his tax of this, we know which part as yet. Alright. So after we have gotten to this part now, all those things, 'cause what we are doing here, we are looking to calculate the profit that the tax that each person would pay individually, right? 'Cause remember that tax is paid individually by partners. If there's a partnership, you don't pay tax on the partnership. You pay taxes individually as partners, alright? Less NIS of 37,500. No, Jonathan wouldn't pay NIS. Why? Why? Because he's 65. Janice doesn't get any pension relief, but Jonathan get age and pension relief. It's 8,000. Alright. And then now you let your threshold as well. So what happens here, you're gonna add up these two and subtract them from the 3,285,000. You get 2,741,188. Add up all these three, subtract it from the 3,257, and you get 2,589,688. Alright. And then now let's tax at 25%. You multiply 25% now, 0.25 by 2,740,188, and you get 685,047, and multiply 25% by 2,589,688, and you get 647 for this one. Then now the question says what? Less estimated tax. Because it said you do the 14, then pay the estimated tax of what? 130,000 and what? 90,000. So you're going to less estimated tax now. And this will be a tax due for Janice, and this will be a tax due for what? Jonathan. And that's how it is done. Alright. Now we will look at some notes here. Note 1 says that Jonathan is entitled to the full pension relief because he's over 55, even though his pension income is less than what? The relief. Jonathan is also entitled to age relief because he is what? 65 in the year of assessment. This year of profits, 2,835 is below the 3 million for the year. Therefore, no minimum business tax is due for these persons. And thank you very much for listening to this clip. Look forward to the others.